Today, we're talking about investing passively into real estate and diversifying into a fund, into a diversified real estate portfolio. And so, this is something we're very excited about launching. It's been something our investors have been asking for a while. And so, very excited to share with you how this is structured and really our investment thesis here. So, before we get into all the details, I want to give first just the disclaimer that this is not an offer to sell securities. You need to review the full PPM, which we will have available for you, and review all the risk factors, et cetera. I will make forward-looking statements and projections, but past performance is not necessarily indicative of future performance. So, got to give the caveats. And with that, let's jump right in. So for some of you, these faces may seem familiar, but for a lot of you, you may be new to Aspen Funds, maybe just getting to know us, a little bit of our management teams. We have four partners here. Our two co-founders are Bob Frazier and James Mafuccio, and started Aspen almost 11 years ago now. And really the genesis of Aspen started in looking for opportunistic ways to invest. And this was, coming out of the great financial crisis in 2012, saw an opportunity in distressed real estate mortgages. And since that time have, scaled that business to be one of the bigger middle market players in our space. And then using that same approach several years ago, we started looking for other opportunities that we saw, given the current macroeconomic trends happening in the economy. And so it's really formed the basis of how we look at opportunities. And I'll get to that in a minute. But Bob's our co-founder, chief financial officer. Jim is our managing director. Dan here, you may have seen him. He's our chief operating officer. He's a former general counsel at a large publicly traded mutual fund company. And then myself, I'm the chief investment officer. And so I'm responsible for vetting, sourcing, forming all the capital markets for our deals. And you may have seen me on the Invest Like a Billionaire podcast as one of the hosts. And as I mentioned, our team and the way that we do things is a little bit different than maybe some other operators or sponsors that you've seen. And the biggest difference is that we're not just in one asset class and, that's all that we do. We're a hammer, everything is a nail. We really look more broadly. And so we start with a top down framework. We want to look at what are the macroeconomic trends that are currently in play, and then how long do we expect those trends to continue? And then how do we position ourselves and our investments to benefit from those trends? And so we're looking at a variety of investment strategies, a variety of markets, a variety of asset classes, and really looking for the areas that we believe are going to be the best position to have success going forward. And then what we do is we put together, best in class teams, best in class investor friendly structures. And then what we're doing as partners is investing alongside you in every single deal that we put out to our investors for just very clear alignment of interests. And ultimately, this is really our own portfolio diversification strategy. This is how we are investing, really like a family office in a lot of the different asset classes alongside of our LPs and for that alignment of interest. A little bit of our track record. If you're not familiar with us, we've been going just almost now 11 years, manage about 150 million. That number will be approaching about 200 million here pretty soon. We've been going, like I said, 11 years, been on the Inc. 5000 many years. And my favorite number is here on the right. We have sent back over $50 million of investor distributions since inception. Profits and capital back to investors. So it's always fun to be raising capital because we're very excited about the deals we do, but it's way more exciting to be sending capital back to investors. And so that's one of our favorite metrics to highlight. Experience across asset classes, and this is going to kind of tie into this the whole theme of this fund is that we have a broad experience. We have, as a management team, involvement in lots of different types of real estate, lots of different types of investment, and bring that expertise to this strategy. And so we've bought over 3,500 mortgages in all 50 states through our mortgage note funds. We have over 3,000 units across all vintages, Class A, B, and C, and multifamily and self-storage. We manage over 400,000 square feet and growing in industrial and retail centers. And we've also done non-real estate, which you may have seen our oil and gas fund, which is also currently open right now. And so we're really using this approach to help investors get access to different asset classes. And last but not least, before we jump in, got to give the plug here for the podcast. This is something that we really enjoy doing. We actually just recently cracked in the top 1.5% of podcasts globally. So it's been a really fun thing for us to do and to get to share with investors and listeners of just how the ultra wealthy are investing. So it's Invest Like a Billionaire. And appreciate you for all those that you are listening to the podcast and giving your feedback to us. All right, so let's start with the summary here. So, what is this fund? This fund, we're targeting to raise $20 to $30 million of equity that will be pooled together in this diversified fund and then invested into real estate opportunities that we believe present the best risk-adjusted returns in the current environment. And so, we're going to be focusing on multiple asset classes, not just one asset class. Again, across multiple strategies and really following our economic research and macroeconomic trends. And so you're going to get multiple layers of diversification, not only from multiple assets, multiple asset classes, and multiple asset class strategies within those asset classes. We're going to be deploying usually anywhere from $2 to $10 million into each project that we're investing in. We expect the fund to have somewhere between 4 and 7 assets in total, and probably in excess of $60 to $80 million of assets in the fund, and really maximizing investors' return and IRR. So the goal of this fund is really to maximize total return. It's not going to be only a cash flow play. We are going to be investing in cash flowing assets, but the goal is to actually maximize investor return. So we have our income fund, which is really designed for current income. We have our energy fund, which is designed for exposure to oil and gas. And then this fund is really kind of the core, looking for those value add, opportunistic, and really core plus opportunities that are going to be, having a balance of cash flow, but also will be doing development in this fund as well. So some of the key reasons why this makes sense, why you might want to consider this fund. As experienced manager, I mean, you got to know who you're working with and trust the partners you're investing with. And we've been doing this for almost 11 years. As I mentioned, of over 100 years of experience across our management team. And the other kind of cool thing about our strategy is because a lot of times we are partnering with other experienced operators in the deals that we bring into the fund. Those operators are evaluating hundreds of deals before they ever greenlight one, and then we're evaluating also hundreds of deals at another even level. So there's usually, I put here 1 of 500 deals get greenlit in this fund, but it's probably closer to 1 in 1,000 deals that are being reviewed between us and our operating partners before one actually gets greenlit and passes all of the boxes and checks all the boxes that we need for it to fit into the fund. You're going to get diversification. So with this one investment, you're going to get access to multiple different assets into the fund with a single check. So it's reducing your risk from one in particular deal not performing as well as you'd want, which is also reducing your variance of return. Alignment and co-investment. We're investing as principals, not only into the fund but also into every deal separately as well. And a lot of times we are going to be required to personally guarantee the debt, which we have done in the past and will continue to do, which further shows how much we stand behind the deals that we're putting out there. One of the big things too, if you've been following our economic research, you understand how important the macroeconomic trends are to investing and positioning your portfolio. And so with this one check, you get to invest in all the deals that we're doing over the course of about the next year and investing into the themes that we believe are going to be best risk-adjusted opportunities right now. Another really cool benefit by investing in this fund, because you're investing in the fund, we're pooling the capital together, we're able to negotiate better terms into the deals that we're investing in. So if you would invest directly into the deal, you're actually going to get better economics through the fund itself because of that kind of pooled capital nature. And so we're kind of designing that to kind of get the buying power effect, right? Because we have that capital in the fund committed to it. And it's going to be tax friendly. So we're going to be passing through all those tax benefits directly to investors. And, to the extent that we have cost segregation studies, bonus depreciation, all of those great tax benefits are going to be pushed through to our LPs to help defer taxes. So we have 3 classes of shares. They're ultimately just governed by the amount that you want to invest. We're really trying to keep the minimum low on this fund to let as many investors kind of dip the toe in the water with us if this is their first time. So we're keeping it at $50,000 for the Class A share. You can see the different structures here. So it's basically the more money you invest, the better terms you're going to get as an investor, and your end net result will likely be a little bit higher because of that. So we have $50,000 share class, a $250,000 share class, and $1 million share class. I'll get to this here in a minute of the kind of structure and the period of it, but we're planning on keeping this fund open for probably about a year, maybe 9 months to a year, given what the current deal flow is like. And so you can start with 50, and as you see the assets that we're adding to the fund, we'll be communicating a lot about that to investors. You can always add more, and if you really like what we're doing in the fund, you can get up to that $250,000 number and get the better economics. Or if you're starting at 250 and you want to go up to 1 million, that's also an option as well. So you can kind of add to your positions over time. Our target hold period is about 5 to 6 years. So we're giving a little bit of buffer to acquire assets, complete the business plans and execute those, and ultimately just to realize the value that's going to be created in these investments. So, hey, maybe this is your first time investing in a fund versus a syndication. The first question might be, well, why would I do that versus just invest directly in the deal? Well, one of the simple answer is it reduces your risk, right? When you invest in a fund, you get automatically diversification. With that one check, you're diversified into multiple assets, a lot of times multiple markets and asset classes, and that's going to reduce your variance of return. So there's no free lunch in economics, but diversification is pretty close as you can get because that diversification helps reduce the risk of one deal going bad and losing capital. You get that diversification, so it stretches your dollar further. And then really just from an ease standpoint, when you have this one investment, instead of investing in, say, 5 to 7 deals, which is the number of assets we expect to be in the fund, and you're getting 5 to 7 K1s, all maybe with different operators, all, at different timeframes of delivery of K1, it's a lot more from a tax standpoint to manage. This is a single K1. You can invest with a single investment, simplifies the process. Another cool thing that we've done in this fund, I'm not going to spend a lot of time on this because it is, a little bit more in depth, but we have a white paper in our data room about this. And so we've actually made this fund IRA and 401k friendly. And what do we mean by that? Well, we have a lot of investors that use qualified monies, IRAs, solo 401ks. These are self-directed, and they want to keep using those to compound tax deferred in deals like this. And so what we've done, if you have invested in real estate before with an IRA or 401k, you may have heard of something called UBIT, unrelated business income tax. It's generally a negative because if you use leverage on the real estate that you're buying and you generate income off of that, there can be income tax related to the leverage, and the IRS wants to get paid, right? So what we've done is actually design a UBIT blocker. This is a separate entity that sits in between your IRA and the fund, and that blocker effectively blocks the UBIT tax from coming through to the individual LPs in the IRA. So it doesn't eliminate tax exposure because you're going to have to pay the tax man one way or the other. But what this does is it will likely reduce your taxable rate because you're not getting the unrelated business income tax, which is at corporate trust tax rates. You're getting at a corporate C corp rates, which are much lower. And so on a net basis, your return will likely be higher if you invest through that with a 401k. So we put that together. We have a lot more we can talk about with you personally to help you understand it. We have a white paper in the data room. You can kind of see a side-by-side example of what the net results could be, given the different ways to invest. Investment diversification. This is a core tenet of investing theory, and one of the founders and father of value investing, created modern portfolio theory, Harry Malkowitz, and the efficient frontier, one of the Nobel Prize in economics. And basically, I studied finance and did a lot of deep dives into this back in school. And, some of the theory, I have issue with, but at its core, the concept is really simple. And it's, if your goal is to maximize return and reduce your risk, the best way to do that is by creating a diversified portfolio. So, right, we all have the goal of maximizing return, but a lot of times we don't take into account the risk that we're taking in order to get that return. And by just simply investing in multiple things, you're automatically reducing your risk by achieving the same return. And so this is a core tenet of investing theory. Benjamin Graham was quoted as saying, diversification is an established tenet. Warren Buffett says, rule number one, never lose money. Rule number two, never forget rule number one. So this is a great thing to do if you're concerned about the downside. All right, so 5 targeted asset classes. This is really continuing a lot of themes that we've been talking about for a while, of several of the deals we've done in the past couple of years, but we're still seeing these continued trends. So we're going to focus on housing. It's really mostly multifamily, but we are evaluating some build-to-rent opportunities, which are considered multifamily, but single-family product. A and B class, we're looking at industrial projects, retail strip centers, self-storage. We also are going to be including the option to include distressed debt, which is one of the businesses that we've been doing for over 11 years now into this fund. So I'm going to run through these asset classes real quick, and so you guys get a sense of this, the high level. Right? We're looking at the macro first. Why do these trends even make sense? And then we'll be sharing a lot more as each deal comes out with the actual more of the macro data, but all the micro data of why this deal in this asset class. But just at a high level, if you're not familiar with some of these asset classes, I wanted to give you a sense of why we're so excited about some of these asset classes. So industrial is probably one of our number one focuses from a real estate standpoint because of what's going on right now. And so I've been talking a lot about this on the podcast and other podcasts, but there's really a phase 2 of an industrial boom happening in the market, and it's being driven by really 2 things. One of it is reshoring, bringing inventory back to the U.S. to reduce supply chain risk, and then manufacturing, bringing manufacturing back to the U.S. or into closer trade relationships like Mexico. And this trend is what we believe the beginning of a decades-long trend of reshifting the whole global landscape of really deglobalizing. So we've kind of over-globalized over the past several decades. And so what's happened is there's been a massive amount of demand. You can see here the chart on the left, the supply and demand. You can see the completions is the dark blue, the net absorption is the gray, and the vacancy rate you can see there. It's right now still under 4%, which is the lowest it's been in decades, and it's projected to be there in 2023. We are expected to have more completions coming to the market, but the absorption is still expected to be very strong. And this is despite a lot of people are concerned about the economy crashing and there's a huge recession coming. Well, one, I don't really buy that necessarily. Maybe we have some turbulence coming. I mean, with the interest rates as high as they are, we are going to have some bumps in the road. But even despite that, the tailwinds of bringing manufacturing to the U.S. These are long-term decisions that are being made at the corporate levels of these companies to decide that we need to shift strategically to the U.S. For a lot of reasons. I'm not going to go into all of it. I could spend a whole hour on that itself. But we're seeing very strong demand despite it, and we're continuing to see sales price cap rates just go in the right direction even still. So we have not seen much retracement in price or reversion of cap rates even right now. Multifamily, there's a lot of concern in multifamily, and we have some of that concern as well, really from a capital market standpoint and the types of deals that were done over the past couple of years, really related to the debt. It's going to cause some turbulence and some distress in the market. But if you look at a pure supply demand standpoint, there still is a massive amount of demand for housing, especially now as mortgage rates are higher. It's driving tenants to rent longer. But even if you take into account population growth, replacing old real estate that needs to be torn down, people that are needing second homes, and all these other things that are driving the need for more housing, it's estimated we're anywhere from a few million upwards of 6 to 7 million units short. Even right now, that's only going to become a bigger and bigger problem because construction starts have dropped about 50% year over year. And so that means new construction being started this year has dropped over 50%. So what does that mean? Over the next couple of years, there's going to be a continued problem of housing shortage, if not even bigger problem. And so you can see here on the chart on the right, this is net change in occupied units over the past couple of years. This is continuing to be very, very strong, even as new completions are being brought to the market. Actually just had a housing rental economist on our podcast named Jay Parsons. You definitely need to listen to that episode. It's very, very informative, talking about all the things going on in multifamily if you're curious on that. And the retail, this is another asset class that we really love. We really, really love it for a lot of reasons. One, retail sales are still very, very strong, and expected to be continued to be strong. Two, the whole market has shifted, right? So we're not talking about big box, malls or even grocery anchored retail or, a lot of these like big box retailers. A lot of those you see are shutting down, but the neighborhood retails space is a sweet spot in the real estate space right now. It's continued to be highlighted. We've shared some of these articles recently to our email list and to our podcast that continues to be on the front page of all these big publications about how neighborhood retail is just surprising everyone because of its resilience. And as people have been, drawn more to their homes, working from home, since COVID, they're frequenting these neighborhood retail spots way more often than they were before. And there's not any new ones being built, right? Because these are generally trading at a price well below replacement cost. So it doesn't make sense for developers to build new strip centers. And so because of that, there's a limited supply. Meanwhile, we have strong demand, and so vacancy has been plummeting. And whenever vacancy goes down, occupancy goes up. Generally, price and rent rates follow that, and so we're seeing that across the board. We have already 4 retail properties in some of our other portfolios right now, and they're all performing very, very well. So we're excited about this asset class. Storage, this is another great asset class that we love. I'm gonna have some case studies here in a minute, but it's very similar, thesis as a multifamily, but there's a continued need for it. The market really, really loves these types of assets. There's a lot of unique ways to play it. I'm gonna share one of a cool case study we did recently on that. The last is distressed debt. And so, we launched our first fund in distressed debt in 2013. So, over 10 years ago, and we've built an incredible track record. And one of the challenges, though, is there's been a more limited supply of new mortgages because it's somewhat counter-cyclical, right? As the market's been really good, there hasn't been as much distress, but we expect that to tick up, and we actually have several large potential trades in the horizon that we're working on right now. And so we are wanting to make this fund, be able to participate in that because it's such an amazing asset class when we can get our hands in these assets. So here's the track record there. We have a full description of our track record of all the assets we've done in the data room, which I'll send link again at the end of this. So you can see how every deal we've ever done is performing in that track record document. And then the last kind of note I wanted to make on the kind of focuses of what we're doing. So we have these asset classes, but one of the kind of core theses of this fund, and we've really of our macro picture, is we really believe development are well poised to perform exceptionally well right now. And so this is really interesting, right? It seems a little bit counterintuitive. Well, why would I be going and doing development, taking more maybe perceived risk when the market's a little bit unstable? Well, here's the reason, several reasons actually. It's very similar to value add in that there isn't much cash flow, in the near term. So if you're looking at comparing it to a value add project, which we've done a lot of, and a lot of investors are used to those types of projects, development is very similar in that you don't have a lot of cash flow in the interim. But what's really interesting is that the cap rates for value add have compressed so much more than any other strategy over the past few years. And so and the prices haven't really retraced yet, right? And so we think there's going to be some softening of pricing over the next 3 to 6 months probably. But even right now, the development projects you're seeing on kind of a stabilized yield on cost or whatever metric you want to look at, it's generally going to be a lot cheaper to build than to buy right now, which is really interesting. And then, from other kind of nuanced factors, new development properties, these are going to have much higher appeal on a sale, right? What we're seeing right now, we've highlighted this on a recent podcast episode of how there's billions and billions and billions, $200 billion has been raised recently from these large funds looking to scoop up cheap commercial real estate. And that's great, right? For if there is kind of a turbulence in the market, but they're really going to be focusing on the newer vintages, the nicer properties in really good locations. And that's really what the appetite is going to be for. So when you buy and build the newer properties, you're going to have much more potential buyers that are available to sell to, and really more institutional buyers that are going to be paying premiums versus older vintages. And a lot of times too, because development has much more upside potential than a value add, you're generally more conservative on assumptions. What we've seen, you build in a lot more margin and a lot more on the back end. So generally, just all around, the underwriting has to be more conservative to make a deal work. But because of that, there's a lot of factors that can really increase the upside potential. The other great thing about these types of projects is you're there's multiple exit points at which to sell. So you can sell upon the certificate of occupancy. So once you've built the product, even before you lease it up, there's a lot of groups that like to do a lease up strategy, or you can lease it up yourself and stabilize the property, do a cash out refinance, and hold it for longer. So there's a lot of reasons we like development right now. We'll be talking a lot more about development projects here coming up. But I wanted to give just a few case studies, right? So, Ben, you're talking all in theory here. You're talking about why you like these things. Give me some concrete examples. Well, I'm going to do that for you right now. So, at a fund level, the strategy is going to be fairly simple, right? We're going to be raising the capital. We're going to be deploying that capital over about a 1 year period. We're going to be investing between $2 to $10 million into the projects that we're doing. Capital will be funded in tranches, and we'll probably build a wait list based on the capital coming in. Um, and we'll be investing in these value add opportunities and ground up development. Then, once we buy the properties or start the development process, we're going to do it right as soon as we acquire the property. And whatever the strategy is for that particular asset, we'll execute the business plan. Then we'll lease up, we'll stabilize, right? So whether it's a value add and we need to renovate and lease up, or we're going to build and lease up, we're going to stabilize the properties, and then we're going to be returning capital back to investors. We expect to return capital in the middle of the fund through cash out refinances of properties that we decide to hold, and or through sales of properties that we decide to sell earlier in the fund life. So we are targeting a 5 to 6 year hold period for the fund, but there will be capital events along the way, with the cash flow kind of picking up in a year 2 or year 3 likely. So here's our first case study, industrial development, and this is something that we've really, really liked and having a lot of success on this particular property I'm going to talk about, and have a lot more in the pipeline. So we purchased entitled land in Wichita, Kansas, which is a great tertiary market here to Kansas City where we are. It's well located. It's got proximity to a lot of international suppliers, great highway access. We're building 2 Class A buildings. We already completed the construction of the first building and have a lot of interest in leasing activity going on there. We're building 340,000 square feet. The great thing with industrial from a development standpoint is it's pretty short window to complete the construction. So we actually started construction in January of this year of the first building, and it's already done 9 months later. And so that's one of the great things. You have a much shorter window to build these basically big boxes, right? Which is nice. And so we invested, into this property. The hold period is expected to be 2 years. It's a short hold period. We're expecting to generate a really nice IRR. We're already seeing really good leasing activity, like I said, and have a line on several other projects just like this one that we expect to put into the fund. Multifamily. So like I said, we are very bullish on multifamily in certain areas and in certain strategies, right? And so we're really going after nicer properties in good locations. This is an example of a property we just recently closed on, a 376 unit Class A multifamily property in one of the fastest growing regions of our country right now in Northwest Arkansas. This is next to Bentonville, right by the new Walmart headquarters. This was a really cool project. We acquired the first 2 phases that were already leased up, stabilized, and we acquired the 3rd phase, which was just being completed. You can kind of see that in the picture there on the top of it, of the new ones coming online. And so it's kind of hybrid play of buying stabilized, bumping rents, increasing amenities, and also leasing up the 3rd phase. It's been a great success so far. Already making distributions to our investors in this project, which is really exciting. Retail strip centers. So I said we love this asset class. So we've already purchased 4 strip centers in the past year, all with the same strategy. And so this case study was a two property portfolio that we purchased. These are both in Johnson County in Kansas City, one of the best submarkets. And it's a really, really simple strategy, right? We're going and buying these strip centers that are in really good neighborhoods. And we're just mostly doing aesthetic improvements. We're making the facade look nicer. We're improving signage. We're improving landscaping. We're resurfacing parking lots. We're just making things look nicer, right? And making people want to come to them. So we're helping drive that consumer to the properties so that then our tenants get more foot traffic, more demand. And by doing that, we can push the rates higher. So we're generally buying these with very low in place rents, because a lot of these properties are owned by mom and pop and investors, and they don't know how to maximize a property. They just think if we're 100% lease, then we're good, right? And so these two properties were, I think one of them was 100%, one was 95% leased when we purchased it. And on these particular properties, we're already doing lease trade out. So the renewals that are coming due, we're bumping the rents. We're changing from gross leases or modified gross leases to triple net, which means the tenant is paying all of the expenses other than property management expense, and they're signing the leases. So we're having almost 100% renewal rate on these because, as I said earlier, there's not any new properties like these being built. So there's just a lot of demand for it, and we're really excited about more of these. This is another conversion project that we did. We're actually marketing this property right now to sell. We only held this for a year. We also got a recent broker opinion of value, so kind of an appraisal light, if you want to call it that, on this project, and already showing an unrealized gain of 20 to 30% if we sold right now, and I've only held it for a year, and so we're actually taking it to market to kind of see what the market would pay for it right now. But this was basically an abandoned retail strip center, but it was an amazing area right by two key highways in Independence, Missouri, and all the surrounding self-storage was 100% leased, and it was terrible. And so we're the only climate controlled in the area. So I believe 120,000 square feet of self-storage that we are building or have already built here, and now are leasing up with great success and potentially going to sell early for a nice IRR. So let me talk to you about the first asset. I'll give you a little sneak preview. We're actually going to be officially launching this asset next week, and we'll be, as I said, updating every asset that we add to the fund as it comes. So surprise, surprise, we got another retail strip center. So we're very excited about this. This is actually across the street from one of the other properties that we own. So we're going to get some great economies of scale from a management perspective and from a leasing perspective, because we own the one literally across the street. This is on one of the main frontage roads called Quivira in one of the best submarkets. And it's kind of crazy to look at the price we got this for. It's trading at about a 38% price discount relative to other recent sales comps we've seen. Usually these are trading around $150 per square foot. We got this one for, I think it's $92 per square foot on this property. And so there's a lot of upside here. I mean, you can see, these are kind of the before pictures. So we haven't done anything yet. So it's nice. The bones are great. It's pretty well occupied. It's I think 82% occupied right now. And there's a lot of just simple things we can do just to make this just a lot more aesthetically pleasing, a lot more attractive to people coming along, a lot better visibility from the road. There's like a ton of these trees they planted that you can't even really see it from the main frontage road. Just simple things, right, that we can do. And the great thing is most of these leases are already on triple net, which really bodes well for having those conversations about lease rate renewals. This is again in Johnson County, and we just are very conservative on our stabilized assumptions. We're only expecting to be 88% occupied on a stabilized basis. And by doing that, we're actually going to be generating close to a 14% yield unlevered. So you see the cap rate there on the right. Year one cap rate, we're buying this at a 8.1% cap rate at 82% occupancy. And then by year three, when we stabilize this, bump up some of the leases and get a few more leases signed, get close to almost a 14% cap rate. So, I mean, if you compare this to other asset classes, right, these numbers, they don't even make sense because they're so much higher than what you normally see. Another thing we really like about this deal, you can see the weighted average lease term here on the right is 1.6 years. So that means over the course of the next 1.6 years, on average, all these leases are going to be turning over. And so we're going to have that ability to have those conversations uh, pretty quickly so that we can get, the leases where we want to get them. So we're targeting 8 to 9% net cash on cash to investors, IRR in the 15 to 16% range, equity multiple close to that 2x number. This is just for the deal that's going to go into the fund. And uh, like I said before, our other assets are performing very well in our first portfolio that we purchased a year ago. It makes up two properties. We're already making distributions to LPs, and right now are distributing at about a 8.6% annualized cash on cash return. So, this is really hard to find cash flow, especially in this market. And we just feel like these are the little darling, jewels to put into a fund like this. And so we also believe from a fund perspective, there's going to be a great balance to a lot of the more development projects that we do where there isn't as much cash flow, right? That we can, have some additional kind of balance on the other end of the spectrum, getting some nice cash flow, nice just core asset to just build into the fund's momentum. What do we have in the pipeline? Well, we have a lot in the pipeline. As I said, we're evaluating hundreds and hundreds of deals to cherry pick the absolute best ones into our fund. We have several deals in the pipeline that we'll hopefully be announcing soon, and so we'll obviously communicate those as they are coming out into the fund. First is a multifamily with some assumable Fannie financing. So we have some very attractive financing that we can assume, which makes this deal really, really good. It's in one of the best locations in the Kansas City submarket here. We have a lot of industrial projects that are kind of teeing up right now. We've been making a lot of offers. We've been looking in a lot of different places, and that activity has really started to materialize into some great things kind of happening here. So we're very excited to be announcing some very similar projects, and also announce some pretty cool stuff that's happening in our other one that we are building in Wichita from a leasing standpoint, and just the activity there just to prove out the concept. We also have been seeing new deals that, we're starting to see trade at kind of crazy numbers. You were talking about this for a while where there's going to be some distress in multifamily, and it's now the time to be buying, right? And I think it feels almost a little early, but I think we're just at the very beginning stages of starting to see some distressed multifamily deals hitting the market, the next 3+ months. So we're already bidding on properties right now that are actually well below replacement cost. And if you believe the long-term trends of multifamily demand, which we absolutely do, then you can see why we're pretty excited about this, right? So now is the time to be opportunistic with placing capital. And so these are the things we're looking at to bring into the fund. And just a little caveat here, we're not under contract on all these deals. There are a few that we're getting pretty close on. So this is kind of representative of things that we're looking at, but not necessarily that we're going to close on all these deals I'm mentioning, which is why I'm a little more vague about it. But we'll be announcing them as soon as we are on a contract to start the capital raise on them. Okay, so as I said before, well, what can I expect? So I gave the range of returns earlier. What's kind of a year-by-year cash flow expected to be? You're trying to be conservative here. This is based on a $250,000 investment. And you can see here, I'm showing the kind of first 2 years limited cash flow. It partly depends on the types of assets that we bring into the fund. So if we have more kind of cash flow heavy projects, we may, be able to distribute cash a little bit sooner. If we do more development projects, we might have a little bit less. We're kind of saying, hey, expect, not a whole lot of cash flow for the first couple of years. Though, we are buying this first retail deal, and we may have more that come up like this that we stick in the fund. Those are going to be cash flowing. So the first year we will, automatically be reinvesting that cash flow back into the fund to be able to purchase more assets. But then in year two, we'll consider making distributions to investors depending on the cash flow we have coming in. And then in kind of year 3 or so, we're going to be looking at doing some capital restructuring depending on what rates are doing at that point. But we're expecting that rates are going to be coming down by then, and can start doing some cash out refinances and or early sales of some of the projects that we're doing to generate a nice capital event. We're going to start cash flowing then, get some nice cash flow built up to when we sell and sunset the fund with all the assets that are in there. Tax benefits, again, we're going to be pushing through all these tax benefits. Obviously, if you're investing through an IRA or 401k, there's not going to be tax benefits you can take. But if you are investing, through individually or through an LLC, you can take those tax benefits. So we're pushing them all through. We expect to produce tax losses in 2023 and 2024, as through the acquisition of a lot of these projects. So what are the next steps here? Very simply, if you want access to the data room right now, you can take a picture of this on the screen. It'll take you right to the data room, and you can start seeing all the information we have in there. I mentioned we have a lot. We have this deck that you can see in there. We've got our underwriting models and our just example of the deals that we got coming on. You'll see actually next week we'll launch this retail deal. We got our full track record in there. Got some other things you can look at. So and the UBIT blocker, like I mentioned. So go there, go to this link. You'll see the data room. We'll be sending this out in the replay, because you can just go right to it and check it out. We'll have this webinar as well if you need to watch the first part if you came a little bit late. You can also always email us, investorrelations@aspenfunds.us, or you can call our team at 800-940-1510, and we can answer all your questions. And so with that, I am going to take a few questions. On the multifamily, saw we excluded C-class. What's the reason for that? Yeah, so we have done some C-class apartments in the past, and it's not that we're against doing Class C in the future. Right now, what we're kind of seeing is the cap rates have compressed probably in that asset class more than any other, meaning the prices for those older vintage properties have got a lot higher relative to other B assets and A assets. And because of that, we actually think there's probably the most exposure or risk from a cap rate reversion standpoint in that area of the market. And so we're going to be really focused on quality and location for the assets that we're purchasing in this fund. Okay, with that, thank you so much. I hope you enjoyed the presentation. Go spend some time digging around the data room. And we're here ready to answer any questions that you have. And as I said, we'll be launching this first asset. You get all the information you want. I have another webinar on that. It'll be in the data room as well next week. And so thanks so much for joining.